Hi, everyone. It is so good to be back here. And as everyone is filtering in, before we get started, I will go ahead and do some housekeeping items. So my name is Ellie. Our presenter today is the founder of Sales Tax and More, Mike Fleming. We have done consistent webinars for years, and we've taken a little bit of a hiatus, and we're starting back with part 1 of 7 pillars. We'll move on to part 2, and then we will be breaking down each of those pillars in the following weeks. So make sure you watch your emails and watch the website so that you can be sure to attend all of those. So if you are here for CPE credit, you do need to do a few things to get that CPE credit. You will need to answer the poll questions as they pop up on your screens. If you have any issues with that, please reach out and let me know. I will help you get that sorted out. You also will need to fill out the survey at the end of this webinar. It should pop up for you automatically, and it will be emailed to you in 24 hours as well. So give us a couple days to get you that CPE credit, but CPE credit is offered for this webinar and all of our webinars. A couple other things to take note of here. If you have questions as we are going along, please reach out and ask those questions. You can use the Q&A button in the middle of your screen. If you wiggle that mouse around, you'll see it. We are going to do our best to answer your questions at the end of this webinar or follow up with you via email. We also will be linking today's slides in the chat box. They will be uploaded to Zoom as a PDF, and we will be sending those out after the webinar as well. So a few ways to get your hand on the slides, and that goes for our handouts as well. And let's do some quick introductions, and you'll have to forgive me. I'm a little rusty on these intros, so if I forget anything, I apologize. But oh, yep, there's a new slide in here. So we are now offering pre-recorded webinars of these live versions that we're giving. You can access them currently through our Salt Vault. There's a lot of things included with a Salt Vault membership, and soon we will be offering those webinars as a standalone as well. So that's kind of evolving and growing. We're adding more pre-recorded webinars as we go along. So watch out for more information. You should have some information about it in your inbox soon. Okay, and now I can do some introductions. First, I'll introduce Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consulting, research, exemption certificate management, audit defense, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out and ask. We would love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and of all industries, and is especially well-known for his work in the e-commerce industry. And Mike, now I will hand it over to you.
Thank you very much, Ellie. Wonderful introduction, and we've got a lot of information to cover today. The 7 pillars, the way this webinar came about is in all the audits I've ever been involved with, they're usually related to one of these 7 pillars. So if you know what the pillars are and you put policies in place to take care of these pillars, you can't avoid an audit. There's no way to avoid audits. But if you are audited, then your exposure should be greatly reduced or even eliminated. So today we're going to do a 10,000-foot overview of these 7 pillars. We're going to do part 1, and in part 1 we're going to talk about nexus, taxability, rates, use tax. We're going to open it up for questions, and then we'll do part 2 next week. And then, as Ellie said, we're going to do in-depth of each one of these pillars, webinars about that. So we're going to be starting this series off or up again. Okay, so as we always say, the worst time to find out that you have problems is when you are being contacted by a state or your client is being contacted by the state It could be by email, could be a Nexus questionnaire, could be a telephone call. And the reason why it's the worst time to find out you have problems is because your options are limited. There are options if you're proactive to mitigate some of the past exposure. However, there is no way to mitigate past exposure if once the state contacts you. Most states, I say most states, there's one or two out there, Michigan, Florida, that will let you still use some of these mitigation options. But for the most part, once you're contacted by a state, and the states do keep record of this, these mitigation options are off the table. So you want to be proactive. And Ellie, at this point, why don't we go to the first polling question?
Absolutely. Mike, when I'm clicking on the poll question box, I'm receiving a blank box right now. And it was working just a minute ago. But when you click on the poll question box, can you see question 1?
Bear with me. Let me see if I can launch it here. Do you see
All
it?
right. Yes, Mike successfully launched this poll. Hopefully it works for me on the next one. And sorry, it looks like we have a quick typo in the heading, but on the number 1, it says, how would you rate your Nexus knowledge? Your choices are, what's Nexus? You know the basics, you have an intermediary knowledge, or you are a Nexus expert, or like we like to say, an expert. And Mike, it looks like we have a really good mix here today. No experts in the crowd yet, but a lot of people who fall somewhere in the middle, couple absolute beginners. Let's give everybody a couple more seconds here, and then we can close it out and move on. And I think it's going to let me end the poll. All right. Great, let's move forward.
Okay. So for those beginners here, let's start out with a quick definition of Nexus. And Nexus is just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection that must be present with a state before the state can require you to do anything like collect its sales tax, or pay its taxes, like an income tax, a franchise tax, a consumer use tax. So this concept of nexus, this connection with a state, is exactly why we say it all starts with nexus. Because if you don't have this link or connection with a state that we call nexus, then you've got no problems and no responsibility. If you do have this link or connection, it's not the end of the world. You just have to look at a couple of other things. Is what you're selling taxable? And if so, then at that point, you'd want to get registered and start collecting and remitting the tax. So it all starts with nexus. Now, there are two types of nexus primarily. We've got economic nexus, which is fairly new. And economic nexus simply means that this link or connection with a state can be based on sales or on transactions or a combination of the two. So South Dakota is the state that introduced this. They, went after Wayfair, and it went to the Supreme Court, and the Supreme Court decided for the state of South Dakota. South Dakota said that if you're selling $100,000 into our state, or have 200 transactions, well, that's enough to create a significant nexus. And the Supreme Court didn't explicitly agree with them, but they sort of did, a wink and a nod, and they sent it back to the lower court for this to be hashed out, but the case was settled prior to this being taken care of. So we may see some litigation going forward, but here we are. We're almost 5 years into this, and we've not seen anything. And one of the reasons is because most of the states have implemented this very well. And at this point, all states with a sales tax, I forgot to say with the sales tax last time, and I was challenged on it because not all states have a sales tax. So all states with a sales tax now have thresholds. And Missouri was the latest state. Theirs became effective on January 1st of this year. So when South Dakota came out with this $100,000 or 200, and the Supreme Court said, "Hey, yeah, this is okay," most of the states jumped in very quickly, and they had $100,000 or 200 transactions. We've seen a lot of the states change their position on the transactions. So we're going to talk about that in a second here. But for example, the state of Missouri, theirs is based just on $100,000. There's no transaction threshold in the state of Missouri. And a lot of states like California and Wisconsin and Maine, they moved away from the transaction thresholds. Now, be careful, because every time I say states have moved away, and that's the current trend, is a movement away from thresholds, transaction thresholds, people say, well, I don't have to worry about transaction thresholds anymore. And that's true. About 50% of the states, or a little less than 50%, still have transaction thresholds. And some of these states are fairly large. Illinois, New Jersey, they still have the 200 transaction threshold. So be cognizant of that. It is moving in the taxpayer's favor. Because 200 transactions in some states, not a lot of transactions. So that's a good trend, but it's not in all states. So we still have to look at that when we're determining our Nexus footprint. Now, something I want to say is this is not an internet issue. This is a multi-state issue. And, our salespeople, they're calling on accountants out there, they're calling on companies out there. And invariably, we'll get an accountant who says, well, I don't have any clients who are subject to this internet tax. Well, number one, it's not an internet tax. Tax and Nexus, two separate concepts. But number two, a lot of accountants don't realize that their clients' business models have shifted. After the pandemic, a lot of companies started selling directly to consumers online because those were the companies that did so well during the pandemic. But that's a separate issue. As far as economic nexus goes, you don't even have to have a website for this to impact you, because it's not an internet issue. It's a multi-state issue. So if you're selling by telephone, if you're selling 100% by referrals, if you're selling by catalog, literally any way that you sell, if you're selling into multiple states, this could impact you or could impact your clients. So not an internet issue. And this comes up at least once a week at this point. So here we are 5 years into this, and some of the trusted advisors out there are thinking they've got the wrong concept here. Even some companies themselves. It's not an internet issue. Now, the other thing is, this does not override any other types of nexus. This is just one more way for the states to get you to do what they want you to do, which is collect and pay their taxes. People tend to think that, well, we've got economic nexus, so physical presence doesn't matter anymore. And that's not the case. A physical presence is going to pretty much trump an economic nexus almost every time when it comes to sales tax. Income tax, not so much, but sales tax, almost every time the physical presence is going to trump the economic nexus. Now, give you some examples here. We get calls probably once or twice a week from existing clients, from prospective clients. Existing clients will say something like, hey, Mike, Texas, our sales are under $500,000. They don't have a transaction threshold, and we want to deregister in the state of Texas. And I say, well, last time we spoke, you had some independent contractors who were traveling into the state. Well, yeah, we still have those, but we're under $500,000. And at that point, I got to break it to them and say, hey, unfortunately, you still have that physical presence. The independent contractors create that physical presence for you. So we, even though you're under $500,000, you still have nexus, and we need to stay registered and collecting the tax. States don't make anything easy. So we've put together a chart here that has a whole lot of information on it. This is one of our complimentary charts. We keep it updated. It's out on our website. It's constantly being updated. We just added 3 new columns on there. It's registration required of all sales or marketplace sales. One is sales tax registration required after a threshold is passed. In other words, is it the very next sale? Is it within 30 days? Is it within 60 days? So it'll tell you. And what type of tax should remote sellers register under? I mean, I see so many problems because people go to a company like an Avalara and they get registered for the wrong type of tax. And then Avalara is doing their returns and they know tax is being collected, but they're not filing any returns because, or they're filing $0 returns because someone signed up for an out-of-state seller's use tax and they should have signed up for the sales tax or vice versa. So this tells you what tax you should be signing up for. It tells you what the effective date was. So if you need to be looking backwards, it tells you what the monetary threshold, it tells you if there's a transaction threshold, and if so, what it is, the calculation methodology. Do you look at the previous calendar year? Do you look at the last rolling 12 months, or do you look at the previous calendar year or current calendar year? And this is the time of the year when that current calendar year becomes important. We had this one company and they only gave me the prior year sales, and this was in April. And, you know, they were a small company. We had them registered in 2-3 states. And when I looked at it, I said, okay, here's 2 extra states you need to register in based upon your economic nexus. And the salesperson came back to me and said, hey, Mike, they were on Shark Tank and their sales have exploded. And I said, well, give me the year-to-date sales then. And when I looked at the year-to-date sales, instead of being registered just in, you know, approximately 5 states overall, they were registered in almost, needed to register in almost 20 states. So if your sales are growing very, very quickly, then if you're in a state that says previous or current, you got to check throughout the year and see where you are. If your sales are growing very, very slowly, then you only need to check every January or so. And if it's previous calendar year, you only need to check every January. So every January, you look at the prior year, were you over the thresholds? If you were, then you should get registered if what you're selling is taxable. If not, wait till the following January. All right, so let's talk about third-party nexus. When it comes to physical nexus, this is the type of nexus that trips up more people. In all my time doing this, this is the one that gets more companies because it just doesn't make common sense. I mean, if we're thinking about how we create a link or connection with a state, we don't think about third parties, people who are performing work on our behalf. But there are 2 Supreme Court cases, one in 1960, one in 1987, that say, yes, third parties can actually create nexus for you if they're helping to establish or maintain a market. So I'm going to, you know, not go through all of these on a case-by-case basis here. These are just some of the activities that third parties can do for you that can help to establish and maintain a market and therefore be nexus creating. What we generally tell our clients is if you're hiring someone, it doesn't matter if you call them a subcontractor, independent contractor, or don't even put a label on it. If you get a company to do something on your behalf, if they are interacting with the public or with your customers, good possibility that that is going to be nexus creating. But it's not all third-party relationships. Let's say you hire someone to develop some software for you and you're paying them on a 1099 basis. Well, that's not really helping you to establish or maintain a market. So that's not nexus creating. Or you hire a bookkeeper, you're paying them on a 1099 basis. Again, not helping to establish or maintain a market. So customer facing activities are usually, or public facing activities, usually going to create nexus. back office type stuff, usually not going to create nexus. Now we've got 10 common nexus creating activities for sales and use tax. This is a free chart. Ellie's going to hand it out to you. It's also up on the on our website. When we say common, this is, the majority of the states, if not all of the states, look at these activities the same way. So ownership of real property, warehouses, factories. I don't know of a state out there that, says if you own real property here, that's not nexus creating. So either all or the majority of the states think the same way on these 10 activities. Whereas that's in direct contrast to these 12 activities. And these 12 activities are state specific. In other words, maybe only one state says that this is nexus creating, or maybe it's a handful of states. But this varies widely between the states. So again, Ellie's handing this out, and it's going to be up on our website also. So if you have any questions about any of these, just go ahead and ask. Before we move on, let's do some sales tax nexus takeaways. Number one, physical nexus is still alive and well. Contrary to what you may believe, economic nexus has not replaced physical nexus. It's just one more way for the states to do what you want them to do, or what they want you to do, which is collect and pay their taxes. Economic nexus not going away. I mean, we're 5 years into this, and there's been 2 surveys. One says 50%, one says 60% of people are not currently compliant for nexus. And we hear these reasons a lot. They say, well, the federal government's going to step in, Congress is going to step in, and they are going to solve this for us. And, there's a case when we talk about income tax. It's the Interstate Income Act of 1959. It was about nexus. It was about income tax. And when it was passed in 1959, and times were certainly simpler back then, Congress said, hey, nexus is so complex and so confusing, we're going to give you a temporary solution here. So we have time to form all of these panels and commissions and do all of these studies so we can get you a permanent solution. Well, at this point, that was 64 years ago. And here we have this, this temporary solution. We still have it. It's antiquated, but that's what we've got. Congress has never done anything. So no matter what your political affiliation is, there are some things that we've had do nothing Congresses for years. And on this subject, maybe our great-great-grandchildren will benefit from something Congress does, but I just don't see them having an appetite to fix anything in the short term. So that's one of the reasons that people have procrastinated. Another one is they think there's going to be litigation, and the Supreme Court may come back and reverse themselves. Well, if the states had really messed this up in their implementation, that might have been real. But for the most part, with the exceptions of Illinois, who I think theirs is discriminatory, and some of the home rule states like Colorado and Louisiana, I think that this is fairly smooth, and economic nexus is not going away. It's here to stay. So don't procrastinate, because some of the states are getting very, very aggressive. I expect more to get aggressive as time goes on, and they're going to be out aggressively looking for people. Independent contractors, major risk factor. That's one of the areas that we often forget to look at when we look at how we're creating a link or a connection with the state. We're not looking at third parties, so that's a major risk factor. And, if you get economic nexus wrong, I mean, 5 years worth of exposure is not good. But with independent contractors, maybe you have 8, 10, 20 years worth of exposure. So that's something that please take into consideration when you're reviewing your own nexus footprint or that of your clients. And then real or tangible personal property owned or leased in other states. That includes inventory. If you own inventory in another state, most states are going to look at that. as Nexus creating. So people always say, well, Amazon's collecting the tax now, so we don't have to count that. Well, unfortunately, states still consider that. Even in Pennsylvania, everyone's telling me, well, there was a court case and state of Pennsylvania lost. Well, the state of Pennsylvania is saying, well, that only applies to sales tax. So for income tax, inventory in an Amazon warehouse in Pennsylvania is still something you got to worry about. California, very aggressive. And a lot of these states are very aggressive when you have inventory in their warehouses. So these are some of the sales tax nexus giveaways. Now, how do states find you? Well, one of the biggest ways for companies that sell on a business-to-business basis is the auditing of your customers. So, when an auditor goes out, they're not just looking at the sales to make sure that the right amount of tax was collected or that it's all being remitted. They're also looking at the purchases, because just because your vendor doesn't charge you sales tax doesn't mean it's a tax-free transaction. You're supposed to be self-assessing and remitting that tax to the state as a consumer use tax, which we're going to talk about. That'll be the last subject of today. But the auditor uses this as a prospect list. When he's reviewing those purchase invoices, if someone didn't charge you sales tax, their name is going on a list. And some states are very formal about this. A separate lead card needs to be filled out in the state of Texas for each vendor that's not charging sales tax. And those, doesn't mean that you're in trouble. I mean, maybe you don't have the vendor doesn't have a responsibility to collect the tax. But you don't want to be in a list, because the discovery units, which is a unit in each state that is responsible for finding new taxpayers, generally from out of state. And, once you're on that list, you may get called in 3 months, 6 months, a year, 2 years, but it's not good to be on a list. Information sharing with other states of the IRS. So we talked about how third parties can create nexus for you. And a lot of third parties are paid on a 1099 basis. So states, Missouri is real big on this. A lot of states are big on it, but they'll go to the IRS and say, hey, IRS, can you give us a list of everyone in our state who's received a 1099? And then they'll compare that to their own tax rolls and see what other taxes you're signed up for. And if you're not, next thing you know, you're getting a call or contact somehow. Leads, former employees. I mean, if an employee knows you should have been collecting tax and they get fired or they're disgruntled for some reason, each state has a hotline or someplace where you can report people for non-compliance. And some states actually pay bounties. So, not only does the former employee get their pound of flesh, they may get paid for doing it. Competitors. This has always been an issue, but it's a bigger issue nowadays. We have a lot of people saying, Mike, I want to collect the tax. The reason I haven't done so is we've got big ticket items, and sales tax can often mean the difference between us getting the sale or someone else getting it. And none of our competitors are actually collecting sales tax. How do I, is there a way for me to get them in trouble, to get them to collect? And unfortunately, yeah, there's a website, pretty much every state, where you can report them. Sometimes you can do it anonymously. Sometimes you got to disclose who you are. Customers, very innocently, they may call a state and say, hey, my vendor didn't charge me tax on this. Do I need to pay use tax? And the state says, well, who's your vendor? Next thing you know, you're on a list. And then purchase lead lists. Sometimes you don't even have to purchase it. You go to Amazon, and Amazon is giving out, their customer lists where people have inventory like it's candy. And the states like Utah, Florida, California are using these lists. Connecticut, Utah purchased a list of people they believe are over their thresholds. So we expect this to be an accelerating trend, especially if we go into a recession here. states generally or historically have increased their discovery efforts when their revenues drop because of a recession. So web surfing, a lot of states do web surfing. Washington is one. Sometimes they do it manually. In other words, they've got an auditor out there and they're just searching the web. Other times they have web crawlers that are out there looking for language. That web crawler is a type of software that looks for language out there that makes it look like you're doing business in their state, even if you're not. So these are some of the ways that states find you. And I can't believe some companies still do this. I mean, I had a salesperson come to me the other day. They said, "Hey, Mike, right on their website, this company says we don't collect tax anywhere except for these 4 states." And they were billed as one of the top retailers in this industry. Well, if you're a top retailer in an industry, I can almost guarantee you probably have exposure in a lot more than 4 states. So we tried to tell them that. They wouldn't listen to us. They knew better. We tried to tell them, at least take this down off of your website, because you didn't even have to, it was a Google search. It was showing up as one of their pages on a Google search. Very easy to find. So if you have any clients who are doing things like this, if they're not registered, if they don't get compliant, or if you don't want to get compliant, at least take the trail of breadcrumbs off of your website. Why make it easy for a state to find you? So these are some of the primary ways. They're not the only ways that states find you, but they're the primary ways. And Ellie, let's go to the next polling question. Do I need to launch it?
No, in that time I figured it out. So it's working
All
for me now.
right.
So second poll question here is, what about sales tax nexus concerns you the most? Quick reminder, you do have to answer these poll questions in order to receive CPE credit. Your choices are nothing, you have it down. Economic nexus, third parties, travel, and other. And Mike, it looks like people are really answering all across the board here. Let's give everyone 10 more seconds or so to get their answers in, and then we can go over it and move forward.
Yeah, and I see economic nexus and third parties. Economic nexus, because it's relatively new, that makes a lot of sense. And third parties, because it makes no sense whatsoever. I mean, most of us look at our own activities and not the activities of third parties. So that's why that's always a big one up there. All right, so I'm going to move on, Ellie. And taxability is the second pillar. And taxability can be extremely granular. I'm going to talk about food. So that's one of my primary loves is food. So when we're talking about candy in Iowa, if it's got flour in it, it's not taxable. So that first picture there is like a Kit Kat candy coated pretzel. The second one is just like a Hershey's bar. Well, that first one is not going to be taxable. And the second one is going to be taxable. So very, very granular. You got to look at whether there is flour in the ingredients. Or how about California? Bottled water, not going to be taxable. So Poland Springs, not taxable. But Pellegrino, if you got bubbles in your water, that is going to be taxable. So taxability gets very, very granular. We don't have time, even in a deep dive, we don't have time to go through the way every state looks at every product. So we're going to do the 10,000-foot overview. And when we're talking about tangible personal property, or TPP, that's something that can be seen, it can be touched, it can be felt, smelled. It's something that can be perceived by the senses, and it's not real property or intangible property. And this is something that by default is going to be taxable, unless there's some sort of an exemption, of which there are many. Now, exemptions can be by item, they can be by use, or they can be by entity. An example of by item is groceries. Some states just don't tax groceries. Some states do. So if everybody in the state is exempt, then you don't have to worry about any type of documentation. You don't have to worry about exemption certificates. If it's by use, and two of the biggest ones are for manufacturing or for resale. If you buy something for resale, that's a type of exemption. And these do require certificates. So, excuse me. And then we have by entity. So the Fed government doesn't pay any taxes. That doesn't mean you're scot-free in all states, because a state like Arizona, the tax is on the seller, not on the purchaser. So the transaction privilege tax still needs to be paid to the state, but it needs to be paid at a lower rate. So municipal governments, in some states, the municipal governments are not taxable, like California and Hawaii. In other states, they are going to be exempt, but they have to provide documentation. And a lot of times we see someone, submitting their letter from the IRS that they're not subject to tax. And that's generally not going to be acceptable. You have to be approved in each state where you're operating or selling or purchasing in order to issue some type of documentation. All right, so TPP is often stretched by statute. Electronically delivered software. I wouldn't think that that's something that is actually tangible personal property, but according to some states, it is. It's defined in their statutes as a tangible personal property. Or electricity. I mean, I guess you could feel it if you stuck a fork in a socket, but otherwise, I generally don't think of electricity to be tangible personal property, but some states say that it is. Tangible personal property incorporated into real property. Generally not taxable to the customer if it's permanently affixed, if it loses its identity, if damage to the property is removed. You hear terms like this. Now, it used to say generally not taxable. I had to add to the customer today because people were saying, oh, well, this is tax-free. It's not tax-free. It's just not taxable to the customer. The contractor in situations like this is generally considered the final consumer and is generally responsible for the tax. So they pay tax on their purchases. And if they don't, then they're supposed to self-assess and remit it as a use tax. So TPP incorporated into the real property is treated differently than other types of TPP. TPP used or consumed in manufacturing, generally not going to be taxable. The problem is every state defines the process of manufacturing differently, and every state has a different start and finish to the program. For example, I was involved in an audit one time, and this company had purchased 2 cranes, and they didn't pay tax on either one of them. And the state was saying, well, you need to pay tax on these. And one of them, we showed that it was actually being used directly in the manufacturing process. And we were able to get that one removed from the audit. But the other one, it was maybe 20 yards away, but it was being used to load the finished goods onto a truck for shipping. And that was outside of the manufacturing process. There was nothing that we could do there. We could not get the state to buy off on any of the theories that we were proposing. So common phrase, predominant usage. I mean, if something could be used for a taxable and a non-taxable purpose, what's it mostly being used for? So let's go to services. So unlike tangible personal property, which is taxable by default, generally services are not taxable by default. Services generally must be specifically enumerated to be taxable. Now, whenever I say that, people walk away and say, well, taxes aren't serviceable. That's not what I said. I said they have to be specifically enumerated. And every year, more and more states are taxing more and more services. And the reason being, tax laws were written when we were a manufacturing economy. Right now, we're a service-based economy, so the states are losing out in their minds on a lot of revenue. So they're trying to make that up. Now, sometimes a non-taxable service becomes taxable when sold in conjunction with tangible personal property. I'll give you a quick example here. California had this out on their website, and most services are not taxable in California. And they talked about drapes, and someone wanted to buy drapes for their bedroom, and they took the measurements. They went down, they purchased the drapes, they gave the measurements, and the person selling the drapes had those drapes, whether they do it themselves or they subcontract it out, they had them altered. That becomes a taxable service because the service is being sold in conjunction with the tangible personal property. Now, when this person gets home, the drapes don't look good in the bedroom, so they decide to put it in the game room, and they take the measurements for the game room. They go down to the local dry cleaners or tailors, whoever's doing alterations in their city or their area, and now it's not a taxable service because it's not being sold in conjunction with the tangible personal property. What we also have to look out for, sometimes a taxable service becomes taxable when sold on a lump sum basis. In other words, if you don't separately state it, if you just have a contract and an invoice that says, here's the entire price we're going to do this for, if there's some taxable and some non-taxable, many states are going to say it's all taxable. And at this point, all states tax at least some services. I don't know of any state out there that doesn't tax at least some services. So that just goes back with my earlier statement. People tend to think, well, Mike said things are not taxable. I said they're not taxable unless they're specifically enumerated. And in these states they pretty much tax all services. So Hawaii and South Dakota, they even tax accounting and legal fees. So if you're an attorney and you got 200 invoices into a state, or an accountant, you got 200 invoices into a state, you could be subject to collecting tax in Hawaii and South Dakota. Well, South Dakota's changing that on July 1st. They're doing away with their 200 transaction. But if you got $100,000 in fees, same thing. So in these states, services are taxable by default. And in order for them not to be taxable, they have to be specifically enumerated. Now, the true object test, people usually make fun of me here. This is when the real New Yorker in me comes out. States sometimes look at what was the customer's intent. Were they intending to buy a good or a service? So I like the dumpster versus the porta potty. And that's the New Yorker accent coming out there. They're both, you see them very often on construction sites. They both have something to do with waste removal. So you'd think maybe they're treated the same, but in most states they're not. When it comes to the dumpster, you're primarily paying for the trash removal. You don't care if they put 20 garbage cans out there. What makes their life easier is they're going to use the dumpster, but you don't care what they use so long as they haul off the trash. So that is usually going to be taxed as a service in most states, and it could be non-taxable, it could be taxable. And you don't worry about the rental of that dumpster. Whereas in the porta potty, that's, the waste removal there, yeah, that's important. I mean, how many of us have gone to a porta potty and it's actually filthy? We wish that it was cleaned more often. But the reason that is, you want those four walls. You don't really want people see you doing your business. So the tangible personal property is important there. So that's usually looked at as the rental of tangible personal property versus a service. Very important test there, the true object test. All right, so services are often viewed through the prism of how a state taxes. So Texas and South Carolina, two great examples of this. In Texas, a lot of people go through Texas quickly, and website design, website hosting, it doesn't say that these, are enumerated services in the big print. So this is a mistake that's made quite often. A lot of accountants, a lot of companies, say, well, it's not an enumerated service. It's not spelled out. But you got to look at the fine print. And for the last 25 years or so, Texas has said that website design and website hosting are actually data processing, and data processing is taxable in Texas. So sometimes you got to do the digging. You can't look at the first thing that you see and say, okay, I'm good. In South Carolina, similar. South Carolina was figuring out how to tax SaaS. They couldn't figure out how to do it. And they said, you know what? You're really connecting to a remote server somewhere. So let's tax this as a communication service. So again, I would not think of software as a service as a communication service, but South Carolina did. Here are some commonly taxed services. By all means, this is not an exhaustive list here, but these are some of the more common ones. All right, so digital property. It varies widely by state, and some states define digital property, some do not. Software is usually not treated the same as digital property. It's usually got its own designation. And this is an area that changes quite rapidly. It may be taxable one day and not taxable the next, or more frequently, the opposite of that, not taxable and then it becomes taxable. So you've got to stay on top of this. And new states are adding rules for digital property all of the time. And one of the things we see that's growing quite rapidly is digital audio visual work, basically a video or some type of audio. And, instructional training on the internet didn't used to be taxable in a lot of states. And all of a sudden it's becoming taxable because it falls underneath this digital audio visual work. And a lot of people say, well, I'm still instructional. Well, that's been redefined in a lot of states. In order for it to be instructional, it's got to be related to like some college course or some high school course or something like that. Most of the time, if it's not, then it's going to be considered digital audio visual and taxable in the states that tax that. Ellie, let's go to our final poll question.
Absolutely. That should be up on everyone's screen right now. The poll question is, which of the following statements is true? A little bit of a quiz for everyone. Services are not taxable in most states. Services are taxable by default in most states. All states tax at least some services, and digital property is now taxable everywhere. And Mike is taking everyone a little bit more time to read through this one, so let's give them some more time. But most people seem to be nailing this one. So why don't we give it 10 more seconds and then you can go over it and we can move on.
Yeah, and the correct answer here is, as most people are choosing, is all states tax at least some services. All right, so I'm moving on here, and we're going to talk about rates. And rates, something that every little dot there, every bit of color change is a new taxing jurisdiction. I've never counted them myself. You're welcome to. We use a number of somewhere around 13,000. I've heard estimates of anywhere between 7 and 15,000. So, by the way, rate determination is something that software does very, very well. I'm going to go back, and in Nexus, software can't get granular enough to tell you. You get a lot of false positives, you get a lot of false negatives, more false positives than negatives, and where you need to register if you're just following the software, because it cannot get granular enough. Now, if you use like our chart in conjunction with it, it's great. It gives you a red flag. It says, hey, check me out. But then you look at your exact circumstances, your exact facts, and you may not need to do what the software is telling you to do. Or even though the software is telling you you're safe, maybe you didn't include your wholesale sales. So now when you add those in, you do need to get registered. So software is a good tool, but it's not the be all end all when it comes to Nexus. Taxability, software cannot help you figure out what's taxable where. Once you figure that out, and once you enter your codes to match their codes, the software does a good job. And whenever there are any changes, it's going to stay abreast of those changes. So software, it's just okay for Nexus. It's good in early warning system. Taxability, the second part of that, it does very well. First part, you got to do manually. When it comes to rates, software does it very well. So what some software companies don't do is talk about, which state's rate do we use? And when we're talking about interstate sales of tangible personal property, the delivery state is generally going to determine the state's rate to use. So wherever we're shipping it, or wherever the customer is taking possession of it, or one of their agents, that's where the sale is sourced. Too many software companies put an emphasis on origin-based to the point where I talk to some people and they say, well, we're origin-based. We don't have to collect tax anywhere. Origin-based only refers to how the local taxes for intrastate sales are determined, not for interstate. When it crosses a state line, it's generally almost always going to be the delivery state that's going to determine the state rate to use. Okay, we just talked about origin. Services are digital property. Services are generally sourced where the benefit is received for sales tax. For digital property, it's a hierarchy of knowledge known at the time of sale. Here's a hierarchy of knowledge. You can read this at your own time. For a lot of companies, they default to the information that they have captured during the actual sales process. This is for online companies. So you got to put in the billing address of either the credit card or whatever. That generally is going to work in most states. All right, so how to figure out the rate? You can call the state or check the state website. There are tools out there. You can use a free rate lookup on one of these tools. You can use a rate table. Now, the first two, if we have some clients that do 5 or 6 transactions a month and they're $5 million transactions. Hey, they have time to call a state and get the rate, or use a state website or a free rate lookup tool. But if you're doing 10,000 transactions a month, there's no way to do that manually. So you've got to automate. So this is where the software actually shines. So I'm a big believer in software if it's economically feasible to figure out what your rates are. All right, so that brings us to use tax. This is the final pillar that we're going to discuss today. And historically speaking, it was widely believed that interstate commerce could not be taxed directly. I mean, even the states didn't believe that you could tax interstate commerce directly. So when the first modern day sales taxes came out back in the 1930s, you had states, companies setting up on a state's border, and they had an unfair advantage because they didn't have to collect the tax, and all the in-state companies had to collect the tax. So in order to level the playing field, states came up with this concept of a use tax, which was not a tax on interstate commerce directly. It was for the storage, use, or consumption of something within the state. So it was really, wordplay, because sellers still had to collect the tax if they had this link or connection with the state. So technically speaking, only sales that never cross a state line are subject to a sales tax. Now, sales that do not cross a state line are technically subject to use tax, but this is really not exactly true anymore, because in 1977, the line started to blur, because at that point, the Supreme Court said that, yes, interstate commerce can be taxed directly so long as it meets this 4-prong test. That was in complete auto transit. So it started changing then. Some states like Pennsylvania took the differences out altogether. But now with Wayfair, states like Colorado have said, okay, if you have economic nexus with us, you no longer collect a use tax. We think that's significant enough. You actually have to collect our sales tax. And it makes a big difference in states because if you're collecting the use tax, you often don't have to collect the local taxes. Whereas if you're collecting the sales tax, you do have to collect the local taxes. Where this makes the biggest difference is in registrations. What type of registration do you have to do? What type of rates you have to charge, and what types of forms do you need to use when doing the returns? For your customers, doesn't usually make a big difference. They just know they need to pay the tax. And even for some executives at some companies, they just know they're collecting tax. They don't know whether it's a sales tax or a use tax. And there are vendors' use taxes, there are retailers' use taxes, there are out-of-state use taxes, lots of names on it, but those all relate to the seller having to collect the tax. Now, we mentioned this earlier, most people know about consumer use tax at this point. Only exempt purchases are tax-free. If a seller doesn't charge you tax on a taxable sale, you're still required to self-assess, accrue, and remit those taxes to the state. And this goes for individuals as well as businesses, but individuals aren't audited, so they don't self-police. And this is a huge area. This is either the #1 or #2 problem for most companies in an audit. They don't handle their consumer use tax directly. So this is something that the software companies are going to tell you, oh, just use our system. It's all the bee's knees, and you don't need to do anything else if you use our system. Well, that's just a flat out lie. I don't know of any system out there that you can enter information in without major revisions to your processes. This is something that for the person doing your consumer use tax, software can be a great tool for them, but you still have to have a person, in my opinion. So you can do it all manually, you can do it all automated, or you can use a blended approach. I think the blended approach is the best way to go. And when you're talking about systems in place, are you going to review all invoices? Well, if all your purchases are, 5 million, you only have 10 purchases a month, yeah, review all your invoices. But most companies have too many purchases to review all the invoices. So maybe you review all invoices over a certain dollar amount. And on the smaller invoices, you do a sample. Also, you may want to target certain vendors because you may know that certain vendors always get it wrong. Maybe they're charging you tax when they shouldn't. So you just want to make sure that these vendors are getting it correct. And there's no perfect solution. Perfection is not a realistic goal when it comes to consumer use tax because you could spend so much money trying to get this right, then you're spending more than any money you're saving. So perfection is not a realistic goal. You just want to catch the major stuff out there. And you also want to catch any refunds. It's not always about what tax you're not paying. Sometimes it's about paying too much tax. So that's why you want to target certain vendors. You could actually be saving the company some money. And at this point, Ellie, why don't we open it up to questions?
Absolutely. And before we do that, just quick, I want to remind everyone, you do have to fill out that survey in order to receive CPE credit, and you can find our handouts within the link or on Zoom that was previously sent to you. So Mike, just to also address this to everyone, someone asked, is the economic threshold by state chart on the sites that we shared? And they're talking about the links to the handouts.
Yeah, all of the handouts today are up on our website. So the website is www.salestaxandmore.com, and the charts and the other handouts are under the resources. So you can find them there. We keep those updated. So even if you get it today, you might want to check back 6 months from now because they're constantly being reviewed and revised.
Thank you so much, Mike. Okay. Does a distributor relationship cause nexus? If the items are owned by the distributor.
My favorite answer is it depends. So I'm going to say in general, the answer is no. If you still owned the inventory, then the answer would be yes. However, maybe that distributor is performing services. Are they accepting returns on your behalf? Are they doing any reps and warranty work on your behalf? So the in general answer is going to be no, but there are services that they could be providing that do create some sort of link or connection with the state.
All right. Thank you so much. Okay. Software electronically delivered SaaS, multiple points of use. Can you address best practice for this?
Yeah, number one, it's important to know that not all states offer a multiple points of use exemption. In the states that do, this is great because if you can issue a multiple points of use certificate to your vendor, the vendor is relieved of all responsibility for collecting tax from you. And it's up to you then to self-assess and remit the tax to where the software is actually being used. So, where it can be used, great tool both for sellers, and it's also a great tool for purchases. But you gotta make sure that you use it in good faith. I mean, I've seen people say, well, we're using 100% of this in Oregon, and Oregon doesn't have a sales tax. Well, bad faith is never something that you want to get into because now it goes beyond what we just didn't know. Now you're actively trying to avoid paying tax, which is never a good thing.
All right. Okay. Any other questions you see that you want to go over quick here, Mike, before we close out?
Yeah, let's get both of these. What states do not charge sales tax? Well, there are 4 states that don't have any type of sales tax. They are New Hampshire, Delaware, Oregon, and Montana. Now, that's a little bit misleading. All of these states actually have taxes that look and feel like a sales tax, but are not called a sales tax. In Delaware, they actually have a use tax on lease transactions or rental transactions. So the person who's renting the property to someone is responsible for collecting that, and the person who's renting it is responsible for paying it. So you got to be careful with what they call these nomad states. And nomad was New Hampshire, Oregon, Montana, Alaska, and Delaware. Well, Alaska, all of the local jurisdictions have gotten together, and you now have economic nexus in Alaska. And these other states, depending on what you're doing, even though they're the no sales tax states, you may have a responsibility to collect and remit. So when you're drop shipping to one of these states that does not have sales tax, in general, there's no sales tax collected. Remember that sales tax is sourced to where something is being delivered. So you would not collect the Washington sales tax. If you have nexus in the ship to state, then the sales tax should be collected in that state. All right. Next one, to confirm, if my Canadian client is selling into the US on Amazon, Amazon will charge and collect and remit tax. But if the inventory is in a warehouse where the client is not selling, they would have to register. Maybe. It depends. I mean, if you're only selling on Amazon, the answer is no, because Amazon takes care of all of the taxes on the U.S. sales. But if you're selling, from Canada into the U.S., or if you're selling on Shopify in addition to Amazon, then yes, depending on the state, and if there was inventory there, then you may have to get registered. Last question. California is currently charging tax on Amazon Prime, which is a service. How is this being connected to a TPP, or is it? I don't know about this specific situation off the top of my head, but we said that services are not generally taxable unless they're specifically enumerated. So this may be an enumerated service in California. And every state taxes some services, and more services are being taxed every day. So more and more states are taxing more and more services. So it doesn't have to be connected to tangible personal property in order for it to be taxable. It could just be something the state says, all right, we're going to start taxing this from now on. Some states do require registration and reporting, even if Amazon is collecting. That is a true statement. However, our clients look at it this way. Most of the penalties and interest are related to the amount of tax that you're going to owe. So if you're only selling on Amazon, what exposure do you have? The state may say you need to be registered, but just because a state says something doesn't necessarily mean it makes good business sense to do so. So most of our clients, if they don't have any taxable sales in a state, they don't worry about registering. There are some exceptions. Some states are going to have a per filing fee rather than it based on dollar amounts of tax that you owe. So it's $50 a filing. That can add up over a 5-year period. But even then, that's not a whole lot of money. So again, most of our clients don't register just because the state says that they should, if there's no teeth in it. If they're can't get in trouble for not doing it, why do it? Why go through the extra expense of having someone or even yourself file the returns? And at this point, Ellie, I'd like to thank everyone for coming today. And I hope that everyone has gotten something out of this. And like we said in the beginning, part 2 of this is going to be next week, and then we're going to delve pretty deeply into each one of the pillars on future webinars. So thanks for joining us today. Hope to see you next time. Bye-bye.